Every quarter, I like to take a look at the main aspects of the overall economy. That means we'll be speaking about inflation, stocks, precious metals and other commodities, and even real estate. We'll touch on debt, employment, and the likely recession that's coming up. There's going to be major tides in 2023, which will have significant impacts on both investor confidence and the wealth effect. And you're ahead of the game already because you're here learning from content on this channel. Now, I know this is going to be a very heavy video. It gets into some pretty sad or depressing stuff. I'm just telling you the lay of the land. I'm just telling you what I see. I'm not trying to scare you or anything like that. But it's a heavy video because the economy is in a heavy place right now. And just like all state of the market reports, it's going to be a bit longer than most videos, but I'm begging you, even if you don't watch the whole thing or if you're going to turn off and go watch something else, skip ahead to the part near the end when I'm talking about the setup that we're in right now. That's some of the best work I've ever done on YouTube, and it just puts it all together and puts it on a silver platter for you. And a lot of this economic setup that we're dealing with right now is leading us all right into yet another debt ceiling crisis, which is mixed in with what will be a spike in defaults and bankruptcies. By knowing which way the wind is blowing, you're going to be more likely to avoid some of the major risks that are out there right now, while getting involved with some of the hundreds of great opportunities that come from the commotion and chaos that's going on in the economy. Some of these stocks that we talk about in the newsletter, for example, I'll tell you about one of them in this video. It's a coal miner. And the reason I'm showing it to you is because it's an example of the great opportunities while the stock market was coming down. We'll get into that just in this video. All of this begins right now, and we're going to go really fast. Let's go. This channel is about your economic survival. This is information that you need now more than ever. Nothing in this video should be considered as personalized trading advice for you. We just yesterday got the latest inflation print. And as you can see, it did again what you were expecting because you educate yourself from content on this channel. Don't get me wrong, food inflation is still strong, it's too high, but it is starting to come down. Inflation is incredibly significant because as we're all feeling the pinch, we're all having a harder time making ends meet, our buying habits change, which in turn has major ramifications on the stocks, which make up or reflect a big portion of the economy. For example, when eggs and bread costs 50% more, you may decide to go out to expensive restaurants or average restaurants less frequently. Or you choose to put off purchases of expensive jeans or luxury items. That affects the stocks of the companies trying to sell those products or services. You yourself may even feel the consumer confidence falling by listening to the conversations around the water cooler at work or talking to your friends and family. You don't need to see a chart for this. You can just feel it in the air. It's palpable. We're seeing the overall economy gradually slowing the world over. You can see it at home. The velocity of money fell off a cliff. But the velocity of money average worldwide around the globe is also slowing. As an example, the European Commission's economic forecast says that most European Union countries are already in a recession. Next, there'll be a recession here in America, which means bankruptcies, delinquencies, rising unemployment, and an overall decline in the quality of all of our lives. When the recession arrives, it'll do a few things. It'll drive away investor confidence and consumer confidence. It will result in layoffs and thus eventually a climbing unemployment rate. Delinquencies and debt defaults will be on the rise, on top of the already significant problems which will come with the much higher interest rates. Speaking of interest rates, remember how I told you that when the rates go up, there's many months, quarters before the rate increase will have an impact. And I'm not talking about that when you buy something on your credit card, it takes a month before you get the bill. There's that effect too, but still, it's typically many months, depending how much they raise the rates or what level the rates are at. When they do an increase of 50 basis points, that starts having the negative effect that they're looking for many months after that. The real estate market overreached and had to come back just naturally, organically. Then add to that the interest rate increases, which are beginning to have the real effect that they were intended to have now. But let me show you the Case-Shiller Real Estate Index. This is interesting. Look at year over year. The real estate index increased year over year. Still wasn't negative, it was still increasing. You think, okay, so we are still above water. But then you take a look at the month over month. And you can see something interesting there, that it's now adding up, that real estate prices are doing exactly what you knew they would do ahead of time. And don't forget, another hit is that with declining real estate prices, you get an absolute reversal of the wealth effect. When your house is worth a lot and it's going up in price, you feel wealthier, you'll spend more money on other stuff. You'll be more active in the economy because you feel wealthier. Even though it's not related at all, really. Certainly not directly related at all. But when the real estate starts to more visibly decline in price, there will be no wealth effect left. It will be the opposite of that. But stocks are one of the things, when they do well, that it also is another wealth effect. And so far in 2023, the direction's been pretty good for most stocks, some of which was short covering rallies, but that wouldn't explain it all. There's been a lot of strength. But there's also so many negative headwinds and dark clouds over us in terms of the economy that I'm going to use a term that I really dislike, and I hate when I read this in an article or someone says it, but I'm going to use it begrudgingly because it's a perfect way to say it. I believe that we're rolling right into a stock picker's market. And I always hear that and I say, well, isn't it always a stock picker's market? That's the whole point of investing. But I'm saying it to you as a caution. You want to be getting into specific stocks which will do well, not only in spite of the recession, sometimes because of the recession. That's a lot of what we talk about in our world famous newsletter. However you look at it though, I believe 2023 is going to be the year of precious metals. Gold, for example, has been so unloved, forgotten, and misunderstood for so long that it makes it a perfect investment. And if you take a look at the central bank buying trends, I'll show you a chart on screen right now about that. And keep in mind that China hides their purchases. They don't report all their purchases, or they give false information, or the lack of reporting. Sometimes they're using proxies to buy the gold so no one can trace it. That's why in that video about China pigging out on gold, I talked about looking at how much gold's coming out of Switzerland, making its way to China, is how you can see how much gold China's been buying. They're just gearing up for a gold-backed currency, which if they pull this off, would be much more valuable for preserving your wealth than the US dollar. It might not be realistic, but if you have a choice between the gold-backed currency or the US dollar, the gold-backed currency should be the superior choice. Russia's got in on the game, India's got in on the game, everybody's pigging out on gold. This is from the World Gold Council, Gold Demand Trends, Q3 2022. I know we're in Q1 2023, but there's a delay on the information. But this is the gold demand trends, and this is 2022 so far. Quarter 1, 87 tons of gold. Quarter 2, 186 tons. Quarter 3, 399 tons. You see the ramping up of the gold buying demand throughout the year? Compared to previous years, each equivalent time frame is higher, and each quarter there's more and more buying. This big increase was huge. It was the biggest chunk of Chinese buying as they prepare for not only war with Taiwan, but a gold-backed currency to replace or fight for market share with the world reserve currency of the US dollar. And I think when we see quarter 4 on this chart, it's going to be quite clear what I'm trying to show you guys. And while the smart nations are pigging out on gold, we are back here in America just racking up our debts, adding to the debts. And this is U.S. national debt over time, and you can see the Civil War, World War I, the Great Depression, World War II. Each time the response was printing more money, which is what you do in times of war. Then we had the Korean War, Vietnam, Iraq, Afghanistan, the thing that we all dealt with for the last few years. But here's a chart of the interest, the carrying costs on the debt we have. $5.4 trillion over 10 years just on interest. Money that just went out the window to allow us to have debt. Debt's a problem. The interest on the debt's also a problem. They're two different problems and they're both equally horrible. What is the current debt? It's $31 trillion. And now we're getting back into a debt ceiling problem. This is an article from CNBC. House Majority Leader Scalise sidesteps thorny question of whether Congress would allow U.S. to default on its debt. If Congress does soon raise the debt ceiling, it would inevitably trigger a default on U.S. Treasury bonds, an unprecedented event that would plunge the nation into financial crisis. America, over time, occasionally hits the debt ceiling because it's like a credit card limit, Scalise said. No, he's wrong. It's not at all like a credit card limit. A credit card company will make sure you have enough money to pay back the amount of credit they're going to give you. That's completely the opposite thing. These guys don't know what they're talking about. At some point, you've got to sit down and say, why are we hitting the limit? Exactly. I'd like to take a crack at it if you don't mind. We're hitting the limit because we're spending more money than we bring in. They always overcomplicate it. It isn't that complicated. And the reason this debt ceiling argument will be much more serious than the ones you've seen in the past that you think just get swept under the rug when they raise the debt ceiling again. Everybody complains about it, but they do it anyway. In the news lately was House Speaker Kevin McCarthy, and it took 15 votes to get him to be the Speaker of the House. And every time he gave concessions, some of the concessions he gave changed the rules about how they deal with this debt ceiling problem. You're going to see exactly the downside of what I'm talking about right now when they actually get to the point where they're arguing about and trying to settle on whether or not they're going to raise the debt ceiling. People are going to assume it's the same thing just again and again. This time it's going to be different. Fiscal deadlines will pose a greater risk this year than they have for a decade. The debt limit is going to be a problem. Lifting the debt limit does not authorize any new spending. It allows the government to borrow more money to cover existing commitments. Since the federal government consistently spends more than it takes in tax revenue, lawmakers have to periodically raise the debt ceiling. Failing to lift the debt ceiling could lead to a government default on its debts and halt daily operations, causing potential turmoil to markets and the economy. Teachers wouldn't get paid, nurses wouldn't get paid, soldiers wouldn't get paid. A Moody's Analytics report from September 2021 said a default on Treasury bonds could throw the U.S. economy into a tailspin as bad as the Great Recession. Moody's projected a 4% GDP decline and the loss of nearly 6 million jobs if the U.S. defaulted. Defaulting on the debt could delay Social Security and Medicare benefits, salaries for government employees, military personnel, and contractors, as well as other spending already authorized by Congress. Lawmakers have permanently raised, temporarily extended, or somehow changed the definition of debt limit to avoid a default 78 times since 1960, according to the U.S. Treasury. Think about that. That's what I tell you about how they changed the rules, they changed the game. They changed the definition so they wouldn't default on their debt. A problem is that most of that debt that the government has is owed to U.S. citizens. So you say, well, we could default on a debt if we owe it to another country. What are they going to do, invade us? But a lot of that debt is owed to American citizens. So you either stiff them or you inflate away the value of the money that you do have to pay them. But either way, this debt bomb is going to explode. Everyone thinks we'll just find ways to rearrange the wording. That'll take you so far. How far? To this point. All right, I'm going to wrap it up for you. This is the best part of the video. Everyone's in a very different situation, and you need to decide what's best for you to do in any situation. And speaking of this, specifically related to this, I want you to try and pick out 2 words from this testimonial we got. I know it looks like I'm trying to promote something, but this is why I did at the end of the video. There's 2 specific words that stood out to me that tells the whole story. Hello, Peter. I've been soaking up your YouTube videos. Awesome information that, if applied, will put a person in a great financial position during 2023, 2024, and beyond. You and your team have been spot on. I'm so thankful I found you and your team a couple years ago and became a lifetime subscriber. Thank you and keep rocking it. Drew, awesome testimonial. Thank you, brother. What I wrote back to him was, you nailed it when you said, if applied, many people come around after the fact to say, I should have listened to you. And there's more of that lately than there has been in a long time because we've been calling it pretty right for a while now. And that's what the newsletter is all about. Suncoke Energy has had a great run so far, climbing from $6.54 in mid-October to a high of $9.05 on January 9th, which translates into a 38% theoretical gain in a matter of months. And this is what I always talk about, the opportunities. A lot of them all around you. You might not notice them because it's a boring investment, but even when the markets are going the wrong way, there's always great opportunities. Okay, so here is the setup that you're looking at right now. You've got real estate in decline, and that will pick up downward momentum. That's happening right as we roll into a recession, which means layoffs and bankruptcies will rise. Just at the same moment that the weight of the increased interest rates have begun to have their effect. In terms of precious metals, as long as there's more demand than supply, prices will keep rising. And since gold's one of the best performing assets of all types right now, it will finally be on people's radar. The media is loosening their blackout on the topic, and as it forces its way into the headlines, more people will take notice of it. In my opinion, the miners are going to increase very significantly if they're high quality miners. However, there is a downside. There's a depression risk. What if this gets to be more than just a soft landing or a gentle recession that some people are talking about? The closer we get to a serious recession or a depression, that's when you have more risk because everything declines. Even gold and silver, precious metals, will decline in that event. It won't necessarily evade the downward slide, but I believe that if that happens, it's going to be a temporary thing. That's when I'll be on YouTube here telling you, just wait. But what's going to happen is that once the Federal Reserve does break the economy, they're going to pivot. They're going to overreact with their only tool, which is quantitative easing. That's why they keep going back to it. There's nothing else they can do. That's why we got QE1, 2, 3, not QE, QE infinity. Just like the debt ceiling. The reason it never goes away is because they don't fix the problem. I tell you that every time ad nauseum. What the quantitative easing is going to do, it's going to reignite a major inflationary trend and quite possibly be the send-off into a multi-year inflationary trajectory, which will eventually lead to hyperinflation. If they do one bout of QE, we might be able to not go into hyperinflation. But if they come over the top after that, I believe that that's when hyperinflation will see the actual beginnings. In any scenario, at that point, gold prices will be well above $10,000 an ounce. And I'm just saying 10,000 is a round number. It'll be much higher than that. So for example, let's talk about Germany in 1923. The equivalent price for 1 ounce of gold went from 100 marks through the hyperinflation, eventually got to 20 trillion German marks. 20 trillion. You say, yeah, but what if you take that gold and sell it for 20 trillion marks? What are you going to do with that? It's just German money then. You haven't really gotten wealthy. You just got a whole bunch of useless currency. The point is, the currency, the German mark, melted. It disappeared. And all that was left was gold. There was no other form of money in Germany at that point except gold. You could take gold and buy as much as you wanted with it. And that's part of the reason that I'm so bullish on gold, because I believe that as inflation happens, further down the road, first it's going to keep coming down, but as inflation ramps up, that's very good for gold. This channel is about your economic survival, and it's information that you need more right now than you ever have. Please subscribe to the channel. Consider joining the Peter Leeds Army, peterleeds.com/army. And we love you guys. Thank you so much for taking the time to sit through this heavy and lengthy video.